Okay, so this is basically what we had done in the first couple of weeks. So we said that we'll take a look at the firm as a balance sheet, and then we said, okay, let's go ahead and see how we can understand all the activities of the firm using this framework. Okay, and what we had done was we said, okay, we're going to know how to calculate the time value of money and so on. And the basic idea was as follows. So we are focusing on the asset side of the balance sheet, okay? And there are two main questions that we are going to address. Oops. So there are two main questions we're going to address. So the first question is, on the asset side of the firm, we know the firm has all of these assets. So what are examples of these assets? So let's scroll up. It's going to have things like raw material, inventory, accounts receivable, property, plant, equipment, factories, machinery, land, and so on. Okay. So what is it going to do with all of these assets? It basically uses these assets to make and sell products and services. So for example, if you're thinking of a company like Tesla, what it's going to do is basically it's using all of its factories, raw material, inventory, and all those things to make the Model 3, the Model S. It's making batteries, it's setting up a manufacturing plant in China, all those things, right? So it's basically using these assets to produce products that it's then going to sell. So it's making and selling products. Now, how will Tesla know that these are good projects? Well, they're going to use the capital budgeting techniques that we've learned. So they're going to use the NPV or maybe the IRR rule. And then they'll see, are these projects good? So if you're using the NPV rule, you're going to see, hey, is the NPV positive? If so, it's good. Undertake it. Otherwise, no, don't take it. Now, we'll see later on that you can also use option pricing techniques, and we'll see a little bit of this towards the end of the semester. But for now, we're going to focus on just the NPV and maybe the IRR rule. Okay. So what we had done was in chapter 4, we had given you the tools to do the time value of money calculations. And then in chapters 5 and 6, you had learned the tools to basically estimate the free cash flows, calculate NPV, IRR, and so on. So what was not done was how do we get the discount rate? Okay, in these chapters. So the second question is, well, if I go ahead and estimate these cash flows, then how do I choose the discount rate so that I can calculate my NPV? And it's basically the finance manager's job. Keep that in mind. No one else is going to check it. So your job has to be to get this absolutely correct, because no one else is going to check it and tell you, hey, this is the discount rate, use it. That's the finance person's job. So keep in mind the discount rate depends on the riskiness of the cash flows being discounted. It does not depend upon the identity of who is doing the discounting. All right. So the only thing that matters is the risk of the cash flows that you're discounting. Why is it important to do this thing correctly, that is estimating the discount rate? Because if you use the wrong discount rate, then the firms are going to make wrong investment decisions, and they may make wrong investment decisions in one of two ways. So for example, a project may actually have a negative NPV, and negative NPV means you're destroying value, you're not creating value. And you might incorrectly estimate it as a positive NPV, and the firm might end up taking that project, but then over time, because the project inherently has a negative NPV, the firm is going to lose value. So the firm value will decline. Alternatively, a project might actually have a positive NPV. It might actually be a good project, but you're using the wrong discount rate, and you may say, hey, the NPV is negative, you will not take it. What could happen? Your competitors might do the calculations correctly, and then they will undertake those positive NPV projects, and they will create a value. So the value of your competitor firms is going to go up, but your firm's value will not. Okay, so that's why it's important to make sure that we get the discount rate correctly. So to summarize, discount rate, expected rate of return, cost of capital, they all kind of mean the same thing for us. It depends upon the risk of the cash flows being discounted, does not depend upon who is doing the discounting. So for example, if we are valuing a T-bill, then the discount rate to calculate the present value will depend upon the risk of the cash flows from the T-bill. So they're basically risk-free, so we'll use RF. So what this thing says is that everyone is going to use the same RF. So you are going to use the same RF as me, Goldman Sachs will do the same thing, IBM will use the same thing when they want to make an investment in T-bills, right? And Amazon will do the same thing, Ernst & Young will do the same thing, the US Federal Reserve will do the same thing, investors in the UK, China, Germany, India, wherever in the world, Japan, wherever, right? All of them will value the US government T-bills using the same risk-free rate. So it depends, so the discount rate only depends upon the risk of this T-bill, does not depend upon the identity of who is doing the discounting. Okay?